Good afternoon, Mr. Travis Pavlik here. I want to talk about Mr. CMG. Check this chart out. $758 up here to where it is now, about 400 bucks. Huge correction. What I'm looking at is this 5-wave down pattern. That doesn't mean it's completely bottomed, it's not going any lower, but in this area I'm extremely interested on playing the long side. I believe that it has skewed risk reward in the favor of a long position. Now, more specifically, has this ever happened before, and is there an analog? If you have not read about, heard about, traded that long, don't know what a 5-wave down Elliott wave pattern is, let's take a look. Let's go back. Go back, young man, look left. This is 2012. Some people might call this an analog. Usually an analog would be a different market with a similar pattern that correlates, right? But I'm just using this to point out what could potentially happen. It doesn't mean that everything in this pattern works. If it was like that, then a lot more people would be on islands sipping Mai Tais. This move was in 2012, as I said. It went from a high of $443 to a $233 low. And as you'll notice, maybe you don't notice, but 1 down, 2, 3, the longest wave, the strongest wave, probably some gaps in there. 4 up, just tip this 200 period SMA, and then finally took out these lows until it bottomed and then reversed. What do we notice about this? Well, they had a extremely it was almost trying to hold support, this inside bar here, and then it completely dropped. So at the end of the move, there's a giant flush out on high volume, almost as high as this end of the third wave. And then you had a weekly entry here where you placed a stop over this in this weekly bar. It didn't get filled, and then this weekly bar, you placed a buy stop above here with risk to here, and you got filled, and then it went on a big streak, ripping to new highs, ripping, and then it went on this huge streak, right? The 10 EMA was support. The 21 period SMA was also support. Then the 50, right? So it held the 50 all the way up until this last little move to 750 plus. Now there's E. coli scares. There's bad comps. We're looking at, also I'd like to point out that the move in 2012 was based on slowing growth, rising costs, all sorts of scariness about the business model. I would argue that this is irrelevant to the technical analysts because to make a lot of money, you need sentiment to be on one side. You need people to say, oh, this company's going out of business. You need the prospects, the stock price to be cut in half nearly. So I'm excited to look at Chipotle going forward. I do have a small position initiated here with the stop below here. I am willing to take several strikes at this. I've been trading this. I'm not saying everyone should. If you have an IRA, why not take a small position and put a stop below 350 on a weekly close? Just plan on holding this for a couple years. That's one strategy. I'm going to be a little bit more technical with it, and it might hurt me. It might be good. But if we take a look at the 5-wave pattern down, using Fibonacci, using Elliott wave, there's the 1 right there, the 2 up, the 3 down, the 4. Right here, this was available before price came into here. I mean, these Fibonacci targets were available. So this is the target for the minimum 5th wave down. And it looks about 380, somewhere around there. So far the lows are 384. Doesn't mean that it's definitely bottomed. This is the typical 5th wave target all the way down at 320. So doesn't mean it's definitely over. We might have not seen the worst of it, but something that I'm watching, something that I'm excited about, something that is the next big trade. The reason why I'm so excited about this is the targets could be as big as new highs, over 750. So let's say 800, right? That's a double from here. Hopefully this helps. Again, I want to stress the expectations for this trade. It's a weekly time frame. So don't approach it like I'm buying on the weekly time frame and then I'm looking at the friggin' 60-minute chart for an exit. One of my mentors, a guy I learned a lot from, says that's the easiest way to torture yourself. Again, if you haven't traded on the weekly or the larger time frame, the risk is going to be bigger than a daily time frame if you standardize risk generally, right? The reason for that is because weekly bars are bigger than daily bars. You need to have the right expectations going into the trade that this is going to take several weeks to play out, that if you want to use weekly closes for your risk management, because it could get completely obliterated, and you're kind of stuck waiting, not really sure what to do. You can wait to the weekly close on the bar to get out, or you can just say, hey, anytime it tips below this new low. But like I said, I'm looking at a weekly entry such as this, or you can wait until the weekly actually closes above the previous close. So the close 2 weeks ago was 397, and the close this week was 400. So that was a weekly close entry, and if it closes below the low of 384, that would be kick it out to the curb. Sorry that's so long-winded. Hopefully that helps. Thank you.